Good afternoon, everyone, and welcome to today's webinar. Today, we're going to be discussing the Ohio Housing Finance Agency's single-family tax credit program. These webinars are brought to us in part by funding from the Ohio Department of Development, so thank you once again to them for their continuing support of these webinars. Today with us, we have Carrie Mano, who is with OHFA, and just in a moment, we'll introduce you to her, but first I wanted to go over a couple housekeeping items with everyone. First off, we will be sending out a copy of this webinar to you tomorrow afternoon around 1 o'clock or so. You should get a copy in your email. I also will be posting it to our YouTube channel, so if you want to share it, you can share it from there as well. First up, we'll be taking questions at the end of today's webinar, but please type them in as you have them into the chat box, and we'll get those answered once Carrie finishes her presentation. And if you encounter any issues during today's webinar, please just close out the webinar, click the link that was sent to you, sign back in that way. Likewise, if you're using a phone, same kind of deal, and that will solve 99% of the problems you may encounter during the webinar. So with us today, we have Carrie Mano, and Carrie joined OHFA in November of 2023 as the Single Family Tax Credit Section Chief, where she administers the Single Family Tax Credit Program. Prior to joining OHFA, Carrie served as the Deputy Chief of the Office of Grants and Tax Incentives and Executive Director of the Ohio Tax Credit Authority. That's a mouthful. For the Ohio Department of Development. She worked as the economic development professional for over 20 years at the city, county, and state levels, focusing on the administration and oversights of property and business tax credit programs and economic development related grant programs. Carrie earned her bachelor's degree in economics from the University of Buffalo and her master's degree in city and regional planning from Ohio State University. So thank you for being with us today, Carrie, and we'll turn things over to you.
Great, thank you, Devin. It's nice to be here. I really appreciate the ability to come and speak with you about this really exciting program. As an aside, I would just like to say that I do actually have history with Heritage Ohio because I actually administered the Ohio Historic Preservation Tax Credit Program directly in rounds, I believe it was 17 and 18, it's been a little bit. And then when I worked at development as the manager of the office, Lisa Brownell was on my staff. So I actually have a lot of history with the historic preservation and the historic preservation program. So that's just my little plug in there to start this off today. But what I'm here to talk about with you today is the single family tax credit program here at OHFA. This is the first of its kind program as far as its size that's set up to assist in the development of affordable workforce single family housing. So the way I usually like to start these conversations, for those of you who own a home, is just to think back on how you felt when you bought your first home, right? I remember when I bought my first house and how proud I was to get the keys and the sense of stability and the sense of place, the establishment of equity, all of that pride that kind of came owning a home. But right now, the dream of home ownership is becoming unattainable as people are being priced out of the market. And so the question is, how can we assist and how do we aid in making these dreams come true? So I present to you the Single Family Tax Credit Program. This program was created following Governor DeWine's goal to increase affordable workforce housing in Ohio, as focusing on housing as one of his administrative initiatives. So this program was created in collaboration between the governor's office and OHFA to advance this focus. The program was created via statute in conjunction with the FY 2024-2025 budget bill. So we're just over a year old now. July 1 was our year anniversary. We have $50 million a year for this program. So for fiscal years 2024 through 2027, we're allocated $50 million a year. And the good news is that the allocation does allow for a carry forward in the statutory language. So if the entirety of the 50 million isn't used in one year, we can carry forward the remaining the next year and continue to allocate. So with 2024, we actually were able to approve a couple projects And then the amount of money that we did not allocate now is living in the fiscal year 2025. So we can still use it right now for the next year. This is a non-refundable tax credit. It applies to the state of Ohio taxes, and the tax credit applies to the taxes of, and this is per the statute, it identifies what taxes this credit applies to. It applies to the taxes of insurance companies, financial institutions, and then trusts, estates, and individuals. So anyone filing their taxes under those certain sections that are called out can utilize this tax credit. So what were the program goals, the conversations, where did we see this and where was the vision? So the first is to increase the inventory of affordable housing. We're doing that by giving consideration to all regions by using allocation pools. So we have a central city, a metro suburban, and a rural. It's a little bit akin to the thought process of historic preservation tax credit. That, of course, is done by the amount of qualified costs. This is a little different, but same too. So we're trying to tier it out to give everyone opportunities to come in for the program. We're trying to balance the needs of the communities experiencing both rapid growth and revitalization of distressed areas. So we're trying to be holistic in our focus. The second is to promote homeownership and qualified buyer support. So we're focusing efforts here to make sure prices are affordable to qualified buyers. We'll talk about a little bit what that means a little later in this presentation. We're requiring homebuyer education and counseling for the buyers of this. Most of these folks are going to be first-time homebuyers, so we want to make sure that we give them the tools to set them up for success in ownership. And finally, we're trying to support green practices and energy efficiency to reduce energy expenses for homeowner. Everybody here knows, I'm sure I'm not the only person who's had a bit of a mega electric bill this year. So we're trying to, again, look more globally and look forward to see how we can get those homeowners at a level of success. And finally, trying to create these stable housing opportunities and development team support. We are encouraging leveraging of other sources to keep the development costs down as far as sources, and to promote projects that are actually ready to proceed. So one of the big questions we always get is, how do we define this project? So I think based on the conversations we've been having, there are certain considerations I think that go into play when anyone is thinking about increasing their housing, if this program is right for him, how this works. So I think first things first, whether you're going down the road in your planning of a single family project, or you're just starting to think about whether this project could be impactful, several items and key points. So the first is, what size project do you need? This program allows anywhere from 5 to whatever. So I think it's a conversation that has to occur locally about what is the need in the area? Where do you want to put it? And what's the target market? All these things need to line up to make sure that this program hits all of the project would hit all of the program requirements. Also key is identifying the developer and assembling a team. If this isn't something that the project development owner can run themselves, how do you identify a developer to help you? There are a number of affordable housing developers specifically. Also, community development corporations are a good strategy. In the application round that we had recently, of the 4 applications that were submitted, 3 were from community development corporations. So a good place to sort of partner with as you're thinking about this program. And finally, what are the financial sources for a project? I mean, we all know it's got to be the money. So talking about assistance from local jurisdictions, finding assistance from other sources, how that all marries in to see what kind of project you can put together and whether this program works for you or not. So aspects of eligibility. Let's start talking about the actual program and what makes a project eligible. So the way I normally talk about this in eligibility, I usually consider it from 3 levels. I consider what makes a project eligible, what makes a dwelling eligible, and ultimately what will make a home buyer eligible for this program. So first, let's start with project eligibility. The first and foremost important piece for project eligibility is the project development owner. This entity is as defined in the statute, is the unit of government that will act as the lead applicant for the project. Now, what I will point out here is when people hear unit of government, a lot of times they're thinking of a township or a municipality or even a county. In our statute, we have definitions of what it means to be a unit of government. It's a little bit wider than that. So it gives a little bit more breadth to who could be considered the lead applicant. So again, that's put up on the screen, but I think key is regional planning commissions, community improvement corporations, economic development corporations, land reutilization. So we can talk to land banks and even port authorities. These are entities that can be partnered with to be the lead developer, or to be the project development owner of the project for this eligibility piece. This is critical for the public-private partnership focus of the program. When we set this up, we wanted jurisdictions to be included in the process, to have ownership, to have input, and to provide additional assistance to offset costs, even work with compliance as the project goes forward. So that is why the unit of government is the lead applicant. It allows the unit to have a strong voice in the process. But as our side, we also realize that some of these jurisdictions just do not have the administrative capability to manage this program. You know, anyone who maybe has been involved with the historic preservation tax credit, for example, you know, there are a lot of requirements. Sometimes it takes a bit to put these applications together. And so what we have created in the rules is the ability for one of these units of government to designate another member of the team as the lead applicant. They would have to do it formally through legislation, but they could then designate another entity as the lead applicant. And then that applicant could still collect all the information, put the application together, coordinate everything, but the project development owner would still be included in the project. I will say, as a quick other aside too, if the project development owner is not the township or the municipal corporation, the application will require a letter from that most local jurisdiction saying that they support the project. We want to make sure, again, this is the public-private partnership, we want to make sure that the local government jurisdiction does know what's going on, and so that's why we have a letter of support inside this application. So next, project development team. These are the entities that we need to bring together to bring the project to fruition and continue oversight of the project through the affordability period. So these are the folks that work from concept to the end of monitoring for this program. The administrative rules and our allocation plan, which the allocation plan is sort of our guidance for the program. It's our guidelines, it talks about scoring, et cetera. It's our active project outline. But both of these places have musts that must be included in the development team. But that isn't a full list. So there are other entities too that can come in. So developer, general contractor, home builder, consultant, constructing lender, appraiser, housing counseling agency. Those team members must be included in the project development team. But other folks that could be added are realtors, because again, this is single family tax credit for home ownership. They're going to be sold, so you can have a realtor as part of your team. Syndicator, this is an entity that could potentially bring in investors. The tax credit is sold to the investors, and then the investors bring direct capital to the program. They could be also included. I've seen consultants. We've had people put CPAs. So basically, it's whoever you think would need to come together to make the project go. That is going to be your development team. Inside this, we also are going to have folks designate a designated reporter who is going to provide information to OHFA every year that is going to say who eventually is going to receive these tax credit allocations. So not a specific member of the team directly, but someone that's going to have to be identified as far as work. So size and type project eligibility. We have a minimum of 5 dwellings for this project to go forward. So there's no max, but our minimum is 5. Projects can be new construction, rehabilitation, or a combination of both. I know that a lot of folks, if we're looking at rehab of historic buildings, we're looking at rehabilitation of the area. So this is what we can talk about. I think conversations could be interesting, and I would definitely encourage you to call in if you're rehabbing a building and putting in place new apartments, if they didn't exist before, new condos, new single family areas. We can have a conversation here. I think that feels more new construction. We'll talk with our legal folks to see, but either way, definitely what you all are doing out there is something that is going to qualify for our program here. For rehabilitation, though, that does have a couple of additional definitions that we use. So it has to be substantial renovation to a building, to an already existing structure that results in the reactivation of habitability. So when this program was put together, the conversation was about increasing the net units. And so we're not looking at circumstances where, say, you have someone who maybe is aging out of their home and is downsizing and hasn't renovated their kitchen in a while. And so they want to renovate their kitchen and then put this up as a single family house for the project. That's not really what we're looking for. We're looking for structures that are blighted, that have to have a minimum of $75,000 investment in that particular dwelling. And we're looking for a replacement of 2 or more major building components. So of course, that would be roof, HVAC, foundation, windows, things of that nature. 2 of those to make that rehabilitation fit the definition of what we need for this program. Sites-wise, the dwelling sites must be under control at the time of application. So either they have to be owned by the team directly, or they can be leased. There's an active purchase contract or documentation from a local government or a land bank that's going to be transferred to the owner. That has to occur at application period. We do allow for scattered sites. So we could do single sites, which is like a multi-acre site for new construction. I know that's not you, but that's kind of how I explain it out in the world. Or scattered sites where you have a number of different locations. So for example, if there was a project where you're looking at multiple historic buildings to come in under a single umbrella, that's something that we could absolutely talk about. So with ownership, scattered sites are the exception to wholly being owned at the time the application comes in. Scattered sites have to have 75% of the sites under control at the time of application. So now that we know about the bigger picture of the project eligibility, let's talk more about dwelling eligibility. What will make an actual structure eligible for this program? So first, we're going to look at the type. They can include, these single family dwellings can include fully detached residential units, duplexes, triplexes, fourplexes, row houses, townhomes, or multi-story condominiums. So those are eligible, which I think is probably of interest to this group, as long as they are owned, that the condominium owned by the person who's residing in there, the condominiums will be considered a single family dwelling for us. Size-wise, they have to have at least 2 bedrooms and 1.5 baths at a minimum. That's our minimum construction standard for the size of the dwelling. And also, it has to be the primary residence of the qualified buyer. So they must live in the dwelling. They can't rent it out during the affordability period, which is 10 years after the initial sale. So affordability. This is also another big piece inside of this program and one of the really big drivers, right? We want to create these single family opportunities for workforce housing, but what does it mean to actually make them affordable? So per the definition, it means a single family dwelling with monthly mortgage payment that is not more than 30% of the buyer's monthly income. So what we're going to add together to get to that mortgage is we're looking at principal and interest of a mortgage loan. We're looking at homeowners insurance and real estate tax and any condo fees associated with it. So all those put together, their monthly total cannot be more than 30% of that buyer's monthly income. This is going to be determined at sale. So that needs, the buyer's monthly income is going to be needed to be considered. Now, people have asked me, what happens if folks, their amounts go up and down? We're looking at sale at the time of sale. So that's just one of the key points. Another piece of affordability is, and this is also a key component of the program, the dwelling has to remain available to qualified buyers during the affordability period, which is 10 years from the date of the initial sale of the home. The way we're going to implement that here is we're going to put together a restrictive covenant entered into by the qualified buyer with OHFA and the project development owner to ensure that this dwelling remains affordable. In this covenant, will require that the buyer remain in the dwelling as their primary residence for the entirety of the affordability period for the 10 years. Now, we do this because we're not looking for the buyer to sell the house in 2 weeks or 2 months or 2 years to simply, right? These are being sold at an affordable level. These are being sold at a market accessible level. So we don't want them sold quickly at the higher market level, and now all of a sudden this is just to realize some kind of capital gain. That's not what we're doing. We're looking to create wealth, but through equity and holding this equity. So that's why this affordability period comes in. We also, though, are mindful that not everyone is able to stay in a home for 10 years. There might be a new job opportunity. There might be family requirements that come up. There might be an ability to purchase a different home. That we understand that. So there will be contingencies in the restrictive covenant in the event of a sale. So if the qualified buyer who purchased the home initially sells to another qualified buyer, there are no penalties. If they don't sell to a qualified buyer, there are going to be penalties, including a recapture of the share of the equity from the sale. So these are just things that we're putting together. We're working on that restrictive covenant right now and hoping to have something available soon. So finally, homebuyer eligibility. So this is about what our eligibility looks like for the folks that are actually going to be purchasing the home. So verified income of up to 120% of the area median income. So the threshold we're using here at OHFA to define the area median income is the HUD home income limits. We were using 2023, but we're going to be upping those to 2024. We'll have those available for folks to see kind of what that maximum income would be. Up to 120%. So it's anyone below or above. When we originally put this program together, we were looking at just 80 to 120. But we had a lot of conversations with folks out there. There are a lot of programs that are available to those folks that are maybe at 80 or below. And we didn't want to exclude the potential to layer those programs together to help someone get into a home. So that's why now we're up to 120. They have to have attained a pre-approval letter stating that they're qualified for a mortgage. They will have had to attend homebuyer education within 12 months of the purchase. And what we're looking for that is housing counseling through a HUD-approved counseling agency. So that can occur. They can access that potentially depending on what lender they use. If they come to OHFA for our first-time homebuyer purchase products, we have that. Some financing institutions, depending on the loan that they're using, requires counseling too. And then there are counseling agencies out there that if you are thinking about putting together one of these programs, we can give you a list of those agencies in the county to get in touch with to see if you can partner with them to meet these qualifications for your folks. credit score of at least 640, and then they have to be either a first-time home buyer or an eligible home buyer. And what that means to OHFA is a first-time home buyer is a buyer who hasn't had ownership in a principal residence in the last 3 years. So that is the window we look at. So if you're working with someone or having conversations with someone who owned a home 5 years ago, but then they had to sell and went into rent, and they're looking to buy again, that's someone who would qualify for us as an eligible home buyer. We're only looking 3 years back. And the other, that's for first-time home buyer, and then eligible home buyer is someone that is a qualified military veteran with honorable discharge or a displaced homemaker. Excuse me. So allocation of funding. Now that we've talked about what makes a project eligible, how are we actually going to get our tax credit allocations out into the state and try to diversify where it goes through everywhere? So we are taking consideration for 3 different sections. We have allocation pools, we have county limits, and we have set aside. So this, again, we're looking to balance not only the distribution of funds, but the needs of the communities experiencing growth or in requirement of revitalization. So first, let's talk about award distribution. We are going to do it on 3 levels. We have our central city, we have metro suburban, and we also have rural. I know the map is a little small, but at any point you can go to our single family tax credit website and see these a little bigger and maybe a little clearer, the green and the yellow. It's a little bit matchy. So central city, and this is on an annual basis what we're planning. So this is per 50 million for each fiscal year. We're looking at 17.625 in central city. That's how much we have allocated for any projects that come in the central city pool. We have 16.625 for projects that come in the metro suburban pool. And we have the 14.125 for those who come in the rural pool. And what you can do if you're working with projects, you can go to OHFA's webpage and map the address or addresses of the project site to let you know where, in which pool you fall. You know, if you're in Columbus, for example, some of those areas bleed into one another, so you can definitely map that to see where you fit. This is based on methodology that we're utilizing in the multifamily tax credit program. So we also have at this point limits on the number of awards per county. Again, we're trying to diversify and disperse some of our awards, but depending on the applications that come in now, those we can work within that, but that's what we have sort of set up in the allocation plan. Set aside categories. We have 2. We have one for Appalachia, which means that for every funding round we have set aside, we will reserve funds for at least 1 qualified project in an Appalachian county. And our other set aside is for, it's called the Transformative Economic Development Set Aside. And this is a set aside for projects that are within a 20-mile radius of an approved mega projects. And that's something that the job creation, the tax credit authority in association with the job creation tax credit project approves. So this is about magnitude of size. So these are projects with more than 2,000 employees. And right now for our round, there are 2 that are identified here. So we have the Intel project in Licking County and then the Honda project in Fayette County. So again, setting aside funds for at least 1 project within the transformative economic development designation. So now that we know the what and the how, now we're going to talk about the actual tax credit, how we can apply it, what this means for you all out there. So the goal of the tax credit is to assist in the capitalization of the project. We bring investor equity and you fill gaps in your capital stack. I talk about sources of funding like a layer cake, right? Everyone out here knows if you've done projects, it takes a lot of different source layers to get to a fully funded project. So this can help fill in the gap in the stack. We're envisioning it in that the sale of the tax credit to an investor through either directly or, utilization of a syndicator. And these are the investors that can actually utilize the tax credit. So again, insurance companies, financial institutions, estate trusts, and individuals. So by selling this tax credit to the investor will purchase the tax credit at some percent of cents on the dollar. And then that influx of cash is a new income stream that can be added to that layer cake of sources. This new source then can reduce the capital that the developer needs to provide, therefore reducing their costs in the project and ultimately reducing the sale price of the home, right? Because if it costs $2 million to do a project, but with the tax credit, now the developer only needs to bring, say, $1.5 million to the table, because they're in for less, they can sell the homes for less, but still reach their margins. So that is the overall piece. It's just another way to get outside funds into that. How do we calculate it? It's the difference. Let me see, did I go too far? No. It's the difference between the total estimated development cost of the project and the appraised market values of the dwellings in the project. This is the appraisal values. We're not talking about sales or anything like that. We're going to look at the estimated development cost and the appraised value. And then what we're going to do is we're going to subtract those two numbers. And whatever that delta is going to be the tax credit. So it's just simple math. And we've allowed so that if the development costs are more, that works. But if the appraised market value is more than the development cost, we can do subtraction. So no matter which one is higher, we just do the math for the delta. So that's the calculated tax credit. We also have a maximum tax credit, which is $50,000 a dwelling. So what we'll do is we'll calculate the tax credit based on the math, and then we'll figure your maximum tax credit, which is number of dwellings times $50,000. And then the reservation, which is what will be allocated, is the lesser of the two calculations. So let me give you a math example. So in scenario one, we have 15 single-family dwellings for a total of $4.1 million in total estimated development costs. And after all the appraisals are done for all of those dwellings, it comes out that the total appraised market value for all 15 dwellings is $3.75 million. So in this case, we take the development costs minus the appraisals, right? Because development cost is higher. So the calculated tax credit is $350,000. When we try to calculate the maximum tax credit, that's when we take 15, because that's the total number of dwellings, times $50,000, which gets us $750,000. In this case, the tax credit reserve amount that's eligible for this project is the $350,000. That's the lesser. Moving on to scenario two. In this case, we've got 10 single-family dwellings, $2.75 million in total estimated development costs, but here the appraised market value is higher at $3.5 million. So in this case, we take the appraisals minus the development costs, which gets us $750,000. So that is our calculated piece. Then again, we look at what the maximum could be. So we take the 10 dwellings times 50,000 each, which gets us to $500,000. In this case, the maximum is the amount that's going to be reserved because our maximum is less than our calculated piece. Now let's talk about issuance. How does it actually work to get it? So at the time of application, which is prior to the project, is when the tax credit is reserved. So an application is put in, we review information, we work to clarify, to cure, and then we'll present it to the OHFA board for formal approval. And that's when the reservation is put in place. That's when we take out that amount of money for your particular project. Then the project goes through. Once the project is completed, that's when we actually issue the tax credit. So at the end of the project, what will have to be issued to us are a final development cost certification. And this is certified by a CPA, just like historic preservation tax credit requires. And then we require post-construction as is appraisal for all the dwellings in the project. In this case, we do allow the entity that did the initial appraisal to just verify that that appraisal value still exists. So you don't necessarily have to go all the way through a full appraisal. You can just get confirmation that that amount is still appropriate. And then we're going to, and those two pieces are what we use to calculate the tax credit. Ultimately, we're also going to want home sale summaries, which shows the recorded mortgage, the recorded restrictive covenant, the verification that there's homeowners insurance. So after we get this information, OHFA will review the final development costs and then the post-construction as is appraisals, and we'll do the math again and verify that the tax credit cannot exceed the original reserved tax credit amount, but it may be a little less depending on what those numbers come in. So the actual amount issued is based on these two final numbers. And then we issue the tax credit to the project development owner. They are the ones in the statute who actually receives it. And the tax credit is claimed annually over a 10-year period. So you'd get 1/10 of the tax credit to be utilized every year. So if your tax credit is $1 million, $100,000 is available every year for use. Now, in this case, what happens after the final calculation, OHFA will issue this eligibility certificate. That is the amount where we say exactly how much tax credit is eligible for this project. What happens then is the project development owner can allocate all or a portion of that tax credit to one or more of the project development investors. So when we were talking earlier about working with a syndicator, getting an investor to buy the tax credit for that influx of cash, then at the end, what happens is annually, the reporter will tell OHFA who actually is going to take that tax credit. So this would be an example of, let's say, Mr. Jones is the investor to the project and buys the whole of the tax credit. Annually, the project development owner would say, Mr. Jones this year will get the full $100,000 tax credit. He is eligible for that. Or if multiple investors have come in, you will just report to OHFA who gets what and how much for that particular year. Application rounds. Our initial application round was due April 5th. We have since expanded on that. We are now, for the rest of calendar year 2024, we are on a monthly round submission. So we originally did a single set date because we're trying to get some allocation out before the end of fiscal year 24. So that was more on the timeline here for us to do that. It's pretty aggressive to go from just the passage of legislation to actually awarding in 12 months. I'm pretty proud that we were able to do that at OHFA. But now what we want to do is open it up to more rounds that are more on the schedule of the developers. So maybe you couldn't make April, maybe you can make September, maybe you can make November. So now we have it a little wider so that every month is, through the end of this calendar year, is something that folks can submit in. We have been able to make awards from our original round submittal. There actually have been 3 awards for projects, which is very exciting to me. One project is in the city of Columbus, one project is in the city of Cincinnati, and then one project is in Portage County, and they split between the city of Ravenna and the village of Windham. So some homes are being constructed in Ravenna, some homes were being constructed in Windham, and the project development owner that came in had an umbrella over basically both those areas, so came in with both of those jurisdictions in place, which is pretty exciting. So that, in a quick nutshell, is our program. I know it's a lot to eat at one time. So here is, I think, for follow-up after you listen and digest, maybe listen to it again. I know it's being recorded. All of our program information is available on our website. So you can read the allocation plan. You can maybe take a look at what the application looks like, just for reference for yourself. If you're thinking about doing this, the kind of information that would need to be collected. We link to the statute, we link to the rules. We have a lot of information available on that. and it all can be found on our webpage. And then any questions at all, if you want a private meeting or have more detailed questions or anything of that nature, you can always reach me. My personal email is at the top, but there's also a single family tax credit email, but I monitor that as well. So either way, to those two addresses, you're going to get a hold of me. And that is the single family tax credit program for you today. I am more than happy to answer questions.
Yes, if anyone has questions, please type those into the chat box now and we'll get them answered momentarily. Taking a short commercial break here. Our next upcoming webinar is next Wednesday, and we're going to be talking with both the Ohio Department of Development and the Ohio History Connection. With the Ohio Department of Development, we're going to be discussing the pipeline funds that can help get properties listed on the National Register of Historic Places. And with the Ohio History Connection, we're going to be talking about CLG funds that can be utilized both for that purpose and also for doing local designations and so forth in districts. And also, coming up October 15th through 17th, if you haven't bought your tickets yet already, our annual conference is going to be taking place in Newark, Ohio. You can find more information on that at heritageohioconference.com. Tickets are on sale now, and early bird rates are available through the end of August. So if you're interested, check that out. And we have a lot of great sessions for you this year in Newark. All right, Carrie, we have our first question here. So when you were talking about scatter sites, how scattered can they truly be? Do they have to be within the same county, or are they going to go just randomly around the state? What's the definition you guys are using?
Sure, excellent question. So for our purposes, we allow scattered sites within the unit of government that is coming in as the project development owner. So if the city is the project development owner, it's scattered sites within their corporate boundary. If it's a county, it can be sites within that county. That specific project, for example, that I told you about where we had 2 jurisdictions, a CDC came in as the project development owner, and they're actually a multi-county CDC. So they focused on Portage County and were able to cover those 2 locations with their umbrella. So again, scattered sites within whatever jurisdictional boundary the project development owner has.
Thanks, Carrie. Our next question is layering of this tax credit allowed with other tax credit programs in Ohio?
You know, it's so funny, and I'm glad you asked that question, because during the commercial break, I was actually thinking I needed to make mention of that. So the answer there is yes, there is no exclusion inside of our program. There's no exclusionatory language with any other program. So I know, and I was at development when this occurred, that of course for example, historic preservation tax credit and LIHTC cannot work together. That is not the case with the single family tax credit program. And actually, we can use other state programs as well. There's no limitation here.
Excellent news. Our next question here, Carrie, kind of going back to the major building component, what exactly is considered as a major building component replacement for those 2 that are required for rehab projects?
Sure. So from and I'm going to get my list so I can basically read everything out to you, but from our standpoint here, so major building component that we're looking at, for example, to pick from the 2 would be roof, HVAC, foundation, windows and doors, plumbing, electrical. So it wouldn't be any kind of interior cosmetic, but if all of this outside siding had to be replaced, anything major within the building.
That's good clarity. Thanks, Carrie. On one question that I had was on the transformative economic development designations. How often do you foresee those being updated around the state?
Sure. So when we put our allocation plan in place, that's going to be for the term of the plan, right? So typically what we're going to do is this is going to be for about a year is what we do. So it's going to be whatever transformational projects meet this criteria at the time that we set up our allocation plan. I actually have direct knowledge on this because I used to be the executive director of the tax credit authority that approved these projects. So right now, I think there have only been, unless they've done 3 or 4 mega projects, or I'm sorry, 4 or 5 mega projects at all that have been approved under that heading. And then there's the additional criteria of that particular mega project would have to have more than 2,000 jobs. So right now it only stands at 2, but we'll look every year as we update our guidelines to see if additional ones have come in.
That's good to know. Thank you, Carrie. Our next question here, it kind of talks about timeline. How long do people have once they submit their applications and they're approved to get the work done before the state of Ohio is like, hey, you're going to get this done or are we calling it back?
Yes. So I will use the examples of the entities in that first April round and what their timelines are. What I would say to after my piece of information is you can go to our website and pull up our allocation plan. And for each different monthly round, we say when the project completion date has to be. So that's outlined directly in our documents. But for our first official round, so for the applications that were approved just recently in June and July here at OHFA, they have to have a completed project by December 31st, 2025. And what that means is all the homes projected in the project have to be constructed and sold by that date. So I think that sometimes can help folks get an idea of scale of project, right? Knowing how much time you have, and for the sales, kind of help to, if you want to do 10 or 20 or, that can help make those decisions.
Thanks, Carrie. Any more questions anyone has, please type those in right now before it's time to go. Right now, just to say thank you, Carrie, once again for doing this webinar. It was excellent material for us. And I think it's something that's really going to be beneficial for Ohio communities. This is really something that I think can also help solve a lot of the housing issues that Ohioans are seeing and affordability issues as well. Carrie, do you have any final comments before we go?
No, I'm really excited. I'm very thankful that I could speak to you today. I definitely think that this is a program that can assist, even specifically in historic preservation. I think that we can work together, like I said, to stack those sources and bring in some financing to help get those projects done. I'm really excited about it. And I would love to speak to anyone who wants to talk to me. I'm always here.
Sounds great, Carrie. Thank you again. I'm not seeing any more questions, so we'll conclude today's webinar. Thanks again to Carrie and OHFA for doing this webinar with us, and we'll see everyone in our next webinar. Thank you.